Hey guys, it's Manny here, and in this video we'll talk about the impact of recession on the investors and the stages of the business cycle. So when the economy heads towards a recession, it's natural for the investors to worry about falling stock prices and the impact that will have on their portfolios. At the same time, you may hear reports of dropping housing prices, increasing jobless claims, and shrinking economic output. But what do housing pricing and shrinking output have to do with my portfolio? And aside from all of these risks, how does a recession affect me as an investor? As you will see in this video, these symptoms are the part of a larger picture which determines the strength of the economy and indicates whether we are in the period of recession or expansion. To understand the state of the economy at the given time and how this affects the stock market, we need to start with the business cycle. Generally, the business cycle is made of 4 different periods of activity, each of which can last for few days to few months to few years. This sequence of changes is recurrent but not periodic. The 4 stages are peak. At its peak, the economy is running full steam. Employment is at or near the maximum levels. Real gross domestic product (GDP) is growing at a healthy rate and incomes are rising. All this positive economic activity is reflected in the stock prices, while share prices for many companies and industries rising to all-time highs. To show their gratitude to shareholders for their continued support and investment, companies may increase dividend payouts. Less encouraging, prices tend to be rising due to inflation. Even so, most businesses, workers, and investors are enjoying the boom times. Stage 2 comes the recession. So what goes up must goes down applies perfectly here. After experiencing a great deal of growth and success, income and employment begin to decline due to any number of causes. It could be an external event that triggers the downturn, such as invasion, Ukraine war, or a supply shock or a COVID, a sudden correction in overheated asset prices, or a drop in consumer spending due to the inflation, which in turn lead firms to lay off employees. During recession, stock prices typically plummet. The market can be very volatile, with the share prices experiencing wild swings. Investors react quickly to any hint of the news, either good or bad, and the flight to safety can cause some investors to pull their money out of the stock market entirely. Because the wages companies pay workers and the price they charge consumers are inelastic or initially resistant to change, cutting payrolls is a common response. Rising unemployment pushes consumer spending down even further, setting off a vicious cycle of economic contraction. A recession is generally defined as 2 or more consecutive quarters of a decline in the real GDP. However, National Bureau of Economic Research defines a recession as any period of significant decline in economic activity that is spread across the economy and lasts more than few months, and uses a variety of factors including GDP, employment, retail sales, and industrial production to make that determination. The trough. Trough is a part of a business cycle when output and employment bottom before they begin to rise again. At this point, spending and investment have cooled down significantly, pushing down prices and wages. Troughs can be challenging to pinpoint while they are happening, but they are recognizable in hindsight. Troughs are the point where business activities move from contraction to recovery. A sign that the trough has occurred or is about to occur is when stock prices begin to rally. This rebalancing of the economy makes new purchases attractive to consumers and new investments in labor and assets attractive to firms. Recovery and expansion. During a recovery or expansion, the economy begins to grow again. As consumer spends more, firms increase their production, leading them to hire more workers. Competition for labor emerges, pushing up wages and putting more money in the pockets of the workers and consumers. That allows firms to charge more for products, sparking inflation and starts low and slow, but may eventually bring growth to a halt and start the cycle over again if it rises too high. Over the long term, however, most economies tend to grow, with each peak reaching a higher high than the last. And if you want me to keep making content like this, please hit the like and subscribe and hit the bell icon. And if this video helped you understand a little bit about recession and business cycles, don't forget to share the video. And on that note, it's me, Manny, signing off.